Hey everyone, today we are going to talk about two companies from their recent filing which seems to have a good potential ahead. The first one is a water solution leader which has secured a 46.5 crore order to deliver ultra pure water and zero liquid discharge systems for a 2 GW solar cell plant in Hyderabad. And the second is travel services major which has teamed up with Google Pay and Mastercard to launch tokenized contactless Forex card payments for overseas travelers. So basically both companies are expanding steadily, one into next gen industrial water leveraging its order book and sector tailwinds, and the other is its digital first travel payments combining strong financials and new partnership. And welcome to the another edition of Noisemaker, where we keep things simple and talk about companies that may not always be in the spotlight but have a strong potential for the future. I am Deepali, Equity Research Analyst at Desvelado Advisory, and today we are going to talk about two companies that are making solid progress in their business, but if current trends continue, they might keep growing even further. But before we begin, here's a quick disclaimer. Any discussion, facts, or writing provided are for information purpose only and do not constitute a buy-sell recommendation. Please conduct your own due diligence before making any investment decisions. So let's move to the first company, Tech Wabag, a global leader in the water treatment business. The company is engaged in the design, supply, construction, and operations of drinking water, wastewater, industrial water, and desalination water. Recently, Wabag secured a 46.5 crore order from RenewSys to deliver ultra-pure water, effluent treatment, and zero liquid discharge systems for a 2 gigawatt solar cell facility in Hyderabad. This is their first full-scope water package for a solar cell plant, and it strengthens their entry into high-growth sectors like solar, semiconductors, and green hydrogen beyond their traditional municipal water projects. The execution timeline is just 11 months, which means the revenue will largely be recognized in FY26. Supporting near-term growth, what's important is that Wabag ended FY25 with an order book to 13,000 crore, which has already risen to 15,777 crore in Q1 FY26. Plus, the company is net cash positive, giving its financial flexibility to bid and execute aggressively. On the financials, in FY25, revenue grew 15.3% year-on-year to 3,294 crore from 2,856 crore last year. Execution was especially strong in Q3 and Q4, though growth was lumpy with the steep decline in Q1 FY25. 32.9% decline, and in Q1 FY26 36.5% decline. Still, EBITDA grew to 430.2 crore versus 376.8 crore, with margins steady around 13%. Net profit improved to 295.3 crore versus 250.4 crore, maintaining a healthy 8.8% margin. So, despite volatility, Wabag has delivered stable margins and earnings. Now, Mudit will be joining in for more. So, Mudit, how do you think this order win in terms of Wabag's broader growth strategy?
Uh, Thanks, Dibali. What strikes me is that how this order is strategic rather than just financial. By entering ultra pure water and zero liquid discharge systems for solar manufacturing, Wabag is stepping into industries of the future. Solar, semiconductors, and even green hydrogen all require advanced water management, and this position them as a key solutions provider. And I'll tell you what excites me further is that there $100 million equity fund with Northfund aimed at boot or HAMP municipal projects in India. This allows Wabag to scale in the PPP space without overstretching its balance sheet, while also building a steady annuity income stream. That's a smart move to counterbalance the lumpiness of the EPC revenues. Right, and with that, I'll tell you what. And I would say, there's a pipelines with preferred bidders status for the projects worth over 35,000 crores across India, the Middle East, and Asia. That gives a strong revenue runway and supports management's confidence in double-digit growth in the years ahead. But Dipali, given this lumpiness in the execution we have seen quarter to quarter, do you think the annuity model can genuinely become stable to their execution.
Uh, that's a great point, Mudit. I do believe the annuity model is a game changer for Wabag. Historically, the company has always dealt with the quarterly volatility because large EPC projects don't recognize revenue evenly. By adding PPP projects with long term contracts, they get a more predictable cash flow base for smoothen out earnings. At the same time, the industrial push into solar and semiconductors creates a new diversification lever. This reduces dependence on municipal water and Middle East contracts and positions Wabag in higher volume industrial solutions. If they can maintain their execution discipline, we might see not just revenue growth but also a re rating of their business model. But Mudit, given the size of their global pipeline, do you think execution risk, especially in overseas geographies, could weigh on margins in the future?
Actually, execution risk is always present in a project based business, especially when scaling globally. However, Babak has shown FY25 that it can maintain 30% of EBITDA margins consistently, even with volatile top line flows. That points to the strong cost control and project management discipline. If they can continue this discipline while gradually increasing the share of annuity revenue, the risk reward looks very favorable. In fact, Wabab could, I would say, transform from being viewed as a cyclical EPC player into a global leader in sustainable water and industrial water solutions. In my view, the next leg of the growth will really depend on how effectively they blend annuity stability with industrial diversification. And if they actually get that balance right, earnings could scale much more smoothly in the years ahead.
Oh, thank you. So let's now move to the second company, Thomas Cook, a leading travel services provider backed by Fairfax through brands like Thomas Cook, SOTC, TCI, and Sterling Holidays. The group operates across 28 countries, making it one of the India's most diversified travel players. Recently, the company partnered with Google Pay and Mastercard to enable contactless cross-border payments via the suite of prepaid Forex cards. This allows customers to make seamless transactions directly from their mobile device without depending on physical cards. The integration of tokenization not only enhances security against theft or loss, but also provides global acceptance at over 270 million Mastercard's merchant locations. The move reflects Thomas Cook's strategy of aligning its Forex service with shifting consumer preference towards digital real time payments. Looking ahead, the company expects a soft Q2 after FY26 but a stronger H2 with Q3 as the key driver. Backed by healthy margins, with 18% PBT growth in Q1 FY26, EBIT margins guided at 40 to 45%, and cash reserves of 22,481 crore. Management remains confident of finishing FY26 on a strong note. On the financial sides, in FY25, revenue was 11.2% year on year to 1723.4 crore versus 1549.9 crore in FY24, driven by steady demand recovery in travel and services. Q4 was particularly strong at 497.2 crore, though Q1 FY26 saw a moderation of 467.6 crore. EBITDA, however, fell to 229.3 crore from 224 crore, with margins easing to 13.3% from 15.7%. Reflecting higher operating costs, net profits stood at 205 crore versus 198.2 crore, with margins at 11.2% versus 12.9%. So overall, top line growth was solid, but margin pressure did weigh on performance, and FY26 has begun on a softer note. So, Mudit, how do you see their digital payments push shaping Thomas Cook's growth strategy going forward?
That's a good question, Dipali. I think this partnership with Google Pay and Mastercard is a smart strategic move. Travel today isn't just about booking flights or hotels, it's about creating a seamless end to end experience. By offering tokenized Forex card payments, Thomas Cook is directly addressing customer concerns around security, convenience, and global acceptance. This also strengthens their value proposition in foreign exchange services, which is one of the most profitable verticals. At the same time, the company's cash reserves of over 22,000 crores provide them with huge cushion to invest in technology and expansion without financial strain. It also reflects the group's ability to withstand near-term softness, like the one they expect in quarter two of financial year 26. Uh, but Dipali, the thing is, given the margins pressure we have seen in FY25, EBITDA margins dropping from 15.7% to 13.3%. Do you think Thomas Cook can defend profitability while still investing heavily in digital initiatives?
Uh, that's an important question, Mudit. I think the key here lies in the how they are scaling their business. Take Sterling Holiday Resorts, for example, they are planning to add 20 plus new resorts over the next 3 to 4 quarters through an asset light model. The strategy reduces capital intensity while still driving scale with occupancies targeted in the 65 to 68% range and ARR guided at 7100 to 7500 in peak seasons. The business can grow revenue without squeezing margins too much. Similarly, in the digital imagining segment, a new software rollout in Q3 FY26 is aimed at boosting productivity and margins. And for corporate travel, their AI-driven Travel One platform should improve self-service and operational efficiencies. These initiatives suggest management is very conscious of balancing growth with margins defense. But Mudit, considering they operate across 28 countries with multiple brands, do you think execution risks, especially integration and cost control, could hold back in the benefits of these expansion plans?
Right, that's definitely the challenge. See, the thing is, Dipali, the multi-brand, the multi-geography operations always carry integration and efficiency risk. However, Thomas Cook has shown resilience in FY25 by still delivering net profit growth, even with margin pressures. And their ability to leverage technology platforms like Travel One and pursue asset line expansion indicates that they are trying to scale smartly and not just aggressively. Right. So the thing is, if they can sustain cost discipline while executing these digital and hospitality initiatives, Thomas Cook, I would say, could actually outpace industry growth in FY26 and beyond. The real test will be how they will convert their strong cash reserves and digital edge into profitable scale without letting the operating cost spiral. So that's the main thing.
Uh, Thanks a lot, Mudit. That really helped us understand the direction both these companies are moving in. All right, let's take a quick look at how some of our previous picks have performed. The first company is Vimta Labs. We picked this at rupees 481.5 and it's now at rupees 710, giving a return of 47.5%. And the next company is Jupiter Lifeline Hospitals Limited from rupees 1499 to 1405. That's a 6.3% decline. And the third company is Travenues Technology Limited. It moved from rupees 194 to rupees 279.9, delivering a strong 44.3% gain. And the last company is MES Financial Services Limited. This one slipped from 324 to 317.2 rupees, which is a 2.1% decline. And the LPEC Solar Limited, we picked this at 1205 and it's now at 1369.9, giving a return of 13.7%. So overall a pretty good mix of gains, and we'll continue to monitor all these companies closely to see how they shape up in the coming years. And here's a QR through which you can access the previous picks covered recently. Now let's see the summary of today's recent filing. Tech Wabag, the company has won a 46.5 crore order from RenewSys to provide ultrapure water effluent treatment and zero liquid discharge system for its 2 gigawatt solar cell plant. And the second company is Thomas Cook. The company partnered with Google Pay and Mastercard to enable contactless cross-border payments across a suite of prepaid Forex cards, allowing customers to transact securely through mobile devices without relying on physical cards. That's it for today's edition of Noisemaker. If you found this breakdown informative, you can scan the QR code to read the full report. We'll be back soon with more simple and clear market updates. Until then, stay curious, stay informed, and stay ahead.